Good morning, everybody. Thanks for joining us today on this beautiful sunny Tuesday. I'm joined here today by my partner, Cooper Zhu, who resides in Calgary with me, currently sitting in our Vancouver office, however. Today, we're going to be talking about Canadian and U.S. tax implications of holding cryptocurrencies, trading in cryptocurrencies, etc. Reminder, throughout this webinar, you're able to ask your questions through the Q&A, which you'll see at the bottom of your screen. You'll just go in there, ask your questions, and at the end of the webinar, we'll take some time to answer questions, and we will stay a little bit longer after the time if need be to answer questions that might arise. Also, you can expect a link when the webinar is over to a survey. Please provide your feedback with respect to what you thought of the topics you'd like to see in the future, any other feedback you could provide us with respect to these webinars that we've been hosting. And finally, you'll see down at the bottom of your screen right by the Q&A, there's something called live transcript. If you'd like to have closed captioning appear during this webinar so that you can read the transcript as well as listen, please click that button and you'll be able to have a live transcript. So as we go through this morning over the next 45 minutes, an hour or so, what we're going to be focusing on is a brief description of what cryptocurrency is for purposes of when we're looking at it for tax reporting and how it can affect you. And also we're going to be looking at the Canadian and U.S. tax treatment as when it's taxable, when is it not taxable, when are there issues with reporting as well, and what type of different reporting forms exist both in Canada and the US for holders of cryptocurrency. Cooper, if you want to take us into a little bit of what exactly is cryptocurrency.
Sure. Welcome, everyone. I mean, cryptocurrency, there's no unified definition, but by the tax authority, it's virtual currency, or we should not say a currency because it's not currency. It's not issued or by any central bank or U.S. Federal Reserve. It's in the digital form. There's no physical form. It's just like a representation of the value in the digital format. So you can use it as a media to exchange, to trade, Basically, it's records. So like the blockchain records the transaction in the ledger. So it documents all of the transactions from the beginning to the end. So you have all of the details. It's different to the real money, real currency we have. If you change your hands, you don't know where your money will go. But in the digital world, everything is documented there. So there are lots of advantages there. That's why it's getting more and more popular. Bitcoin, was invented in 2009-ish, and Ethereum was brought up by this genius gentleman. He's a Canadian. So around 2013 time, he and his friends invented. Nowadays, if you look at the price this morning, the Bitcoin, it's valued about $44,000 US. The cap value is $840 billion. So that's huge. So if we go to the next slides, so Krista, you can talk about how the RS or CRA nowadays, they try to screw, because there's more and more transaction in the digital world, they want to put more regulations.
Yeah, that's right.
Revenue on it.
Exactly. As it's interesting because the governments always tend to try to keep up as the world evolves, if you will. So sometimes things move faster than they can make laws and put administrative positions in place. And that's not any different with any government. And we saw it a while ago with trying to track foreign property, let's say maybe 10 years ago, they're like, oh, we better keep an eye on this because it's becoming a bigger thing with people owning foreign stuff. So they put questions on tax returns, do you own foreign property? Now we're moving into that with cryptocurrency because the government's going, wait a second, we actually have no way to identify at this point in time who owns what, and because there's no regulations, because it's not actually a legal tender. And I think that that's the biggest thing that is, even though it's a computer-based and potentially there could be some type of tracking, there is none at this point. And so it's hard for the government agencies, and they need to put in different administrative positions and regulations and laws in order to be able to capture any type of revenue that needs to be taxed with respect to these investments. Now, as I said, it's not a legal tender. So it's not cash, it's not currency. So how do they look at this? And the way that they've just defined cryptocurrency, Bitcoin, is it's property. So if you were to think of, say, I have this piece of lumber, even though it's not a physical form, that cryptocurrency, that's how they're treating it for purposes of tax. And when you're looking at how the transaction is going to take place, you got to keep in the back of your mind, this is property for purposes of the Income Tax Act. And when looking at the different sections, determining how it's going to be treated. And as I said earlier, it's not currency, but they have come out and said, we actually treat it as a foreign currency. So not only is this property, but we're treating a majority of it as foreign currency because it's sitting on foreign exchanges or foreign wallets or whatever the case may be. And so you have to really dig deep into, what do I actually need to report and how am I going to pay tax on this for income that I've earned on the cryptocurrency if it's not cash, it's not currency, but it actually is. So that it's almost contradicting to one's brain. How is this reporting actually going to take place when on one side they're saying it's something, but on the other side they're saying it's something different? So if we were to look at, how is the Canadian government looking to tax cryptocurrency? The first and foremost main transaction that a lot of people see is exchanging your cryptocurrency for money, but basically buying and selling it for actual legal tendered cash. That, in most cases, you would treat as a capital gain transaction, capital loss, capital transaction. So buying and selling property, similar to as you would with, say, stocks, et cetera. And similar to a foreign stock with the cryptocurrency, if you're holding it in a foreign wallet and you're buying and selling it for cash, you're not only looking at what is the capital gain or capital loss that comes into play with respect to that, but do you have any foreign currency exchange gains or losses? And that comes into account by what's the dollar that you bought it at today and what's the dollar that you're getting back tomorrow. And if there's a difference in that, you not only have the capital gain based on the property disposition, but also any foreign currency translation that might exist as well. So a lot of people I know who are just starting to get into the cryptocurrency, this is what they're doing. They're getting a wallet, they're buying into it and buying and selling it with cash. And that's probably the biggest investor one, if you will, that you'll see out there. Now, what's starting to happen is called a barter transaction. So we'll go back to what I said before, that cryptocurrency isn't actually a legal tender. So when you buy something with cryptocurrency, it's actually considered a barter transaction because you're trading property for property. You're not buying it with cash. And so that's going to be, looking, and if you trade cryptocurrency for something else, again, that's going to be considered a barter transaction. And so what you have to do is you have to actually look at the fair market value of both properties exchanged to determine what the possible gain loss is, or ordinary income if it's considered business income. And that can come into play, say, if you're bartering it for something where the value is maybe not as easily as accessible as what the cryptocurrency's cash or cost basis is. So you might end up getting in a position where you have to have a valuation done of that property in order to figure out where is your variance in this transaction and what type of income do we need to report. Now, again, not much different than any other type of barter transaction that takes place with property, but it's again, keeping in the back of your mind, cryptocurrency is property. So if it were any other type of property, what would I do and how would I treat this?
Hey, Krista, there's an old story there. It's to be verified whether it's true. It says like 10 years ago, the guy paid, 10,000 Bitcoin for just 2 pizza. So that is value like a $600 million if you compare the value of Bitcoin now today. So, that's kind of a bad transaction. Probably you can claim a huge capital loss on that transaction.
Exactly. And I mean, it has to be a third-party transaction value, et cetera, right? So, I mean, the other side of this, does it actually qualify for like-kind exchange if you're doing some type of barter transaction? I think that's still a little bit of a gray area. Although it's property, is it taxable Canadian property? Who knows? So you have to go a little bit further into what is the actual cryptocurrency and what's behind it to determine whether or not it's going to qualify for that. Now, the one thing with Canada and cryptocurrency is you're going to be the cost basis. So when you actually dispose of it, you're going to be looking at your wallet for the average cost amongst all of your cryptocurrency owned versus the first in, first out, which Cooper will talk a little bit later about. Canada views these dispositions as average. There's not much gray area on that. That's the way that they want it reported. So you have to just look at what's your total cost, how much are you disposing it of, divide it, and you get your average basis on that front. Now, the biggest thing, and this comes into play when you're looking at stock traders as well. Is it business income? Is it hobby income? Or is it capital gains? And this is a very subjective test. There's no actual bright line test that says, okay, if you're going to have 100 transactions of cryptocurrency a month, you're in the business. Or if you only have 20, then it's a hobby. It doesn't really give you a test. It's very, very subjective. And if you want to be in the business of being in the cryptocurrency, and it might happen a little bit more in the mining, if you will. But what happens is if you're determined to be actively in the trade of business of cryptocurrency, the income's going to be reportable and you're going to be able to claim expenses as you get it and receive it and as you pay it. Where the risk comes in is if you're trying to treat it as business income and CRA comes back and says, actually, no, we think you're doing a hobby of cryptocurrency, not in the business of trading cryptocurrencies or mining. The risk there is you might have a disconnect between when you incur expenses and when you receive the revenue. And the reason that this is a disconnect, because under a hobby, you can't actually create a loss. So whereas with a business, you can claim the expenses as you go along, create loss for future income inclusions. Whereas a hobby, if you have expenses in year 1 and 2 to get things up and running and investing, et cetera, but then you're selling it in year 3, you can't go back and claim those expenses in year 3. And they're basically lost and you're recognizing the revenue. And you'll probably see this more in mining, I would think, than in the actual trading of cryptocurrencies, this situation with the hobby. And I think that's where a lot of people might get caught lately because they're kind of playing around with the idea of mining and setting up some servers and doing this. And that doesn't necessarily actually mean you're in the business. And so when you receive the income, you may have a situation where you're 100% including it in income, don't get the benefits, capital gains, and you don't get the benefits of your expense. So you really need to be careful when you're doing that, because you want to be able to create an equal effect to offset your expenses and income. And then the capital gain, that's mostly going to come from when you're trading in the cryptocurrencies. So buying some, selling some, as long as you're not what's considered, I'm going to use the stock term of day trader. As long as you're not considered a type of day trader, it's likely a capital gain loss.
So Krista, you mean, if I understand correctly, if you do a mining, you get some cryptocurrencies. It could be taxed as ordinary income, like a business income.
Correct.
Or it can be a hobby income, right?
Correct.
Then when you sell those or exchange the coins you got before, you could realize capital gain or loss.
Correct. Yeah. So when you're mining, you're receiving, okay, so we'll go back, let's take a step. So cryptocurrency earned in mining. When you receive cryptocurrency in the aspect of mining, if you are in the business of mining, as soon as you receive cryptocurrency, that's recognizable income at that time. And then when you then exchange that cryptocurrency for legal tender of some type, you'll recognize a gain loss for the differential and potentially a foreign exchange gain or loss. However, if you're a hobby miner, you're not going to recognize the income until such time that it's fully received. Versus, and it's kind of, this is interesting because I know there's a lot of disputes of when is it received and isn't it just an inventory, if you will, like if you were mining for diamonds or mining for gold?
Yeah, it's kind of different to the traditional mining. We think you mine your gold or silver, usually it's inventory, it's not tax payment.
Exactly. Whereas with cryptocurrencies, when you mine something, it becomes revenue because you're receiving payment rate then for it and it's being used. It's almost like a service payment, if you will, if you were to kind of put it in what our brain normally thinks of terms for tax.
Maybe I can explain a little bit on what the mining is. I know there, from our audience, they might have, lots of experts in the cryptocurrency, but some of those maybe trying hard to understand, what is mining in the cryptocurrency world. So remember, cryptocurrency is like a digital records on a bunch of transactions. So if you group lots of transactions, usually they call it a block. Then you need to verify or validate these lots of transactions in one block. You're trying to get accepted by the larger network. So usually when you join in the network, you wait the order, then you do your service, like you verify the transactions, trying to validate those, then get accepted into a large network in the big blockchain. So this is how we call the mining. It's kind of the service provider. You use a computer, your hardware, you run it 24/7, then at some point you got recognized, you get rewarded by a fraction of either a newly minted cryptocurrency, or you can get a share of the existing cryptocurrency as a transaction fee. So that is a mining process. So now I can see maybe that's why CRA wanted to, try to tax that right away.
Exactly. And, it's interesting because my oldest has some desktops in our basement that are operating as servers. And I was like, okay, they're just old desktops refurbished and they just sit there and run 24/7 doing calculations. And that's all that they do. So it's definitely an interesting thing because it challenges our traditional way of thinking, if you will. But
now maybe you can talk about how to report the cryptocurrency.
Yeah, for sure. Yeah. So exactly. Going on with how does CRA they've treated this for tax purposes and kind of going back again. It's not money, but it's property. Is it foreign? Is it not foreign? And remember, they treat it as foreign currency. So that means when you're looking at reporting, you may have a reporting obligation on Form T1135 to report this foreign property that you own. Now you got to think, where's the wallet? What currencies? Where is it? Servers, all of those different types of things come into play when you're looking at, do I need to report this on Form T1135 for foreign reporting? And, you also are you over 100,000 of foreign property, but you really need to keep in your mind that CRA still treats this as property. So it is likely that it needs to be included on this form. GST and HST is an interesting one with indirect tax because how do you tax something that's not money? right? And how do you pay tax if you don't receive money? So people who are using cryptocurrencies in the barter transactions as payment for product, you really need to be careful because you still need to charge GST. So you're going to be receiving cryptocurrency for your sale. However, you're not getting cash, and CRA is certainly not going to accept cryptocurrencies as payment for GST tax that's due. So you might have some cash flow issues, if you will, that you need to keep in mind if you're deciding to receive cryptocurrency for payment, because you're still going to have to include the GST payment to Canada Revenue Agency on any type of product that has been exchanged. So you don't automatically get out of the GST, HST reporting obligations, even if you choose to use cryptocurrency as a form of tender that you're willing to accept.
Krista, that's right. Last year, actually, the Canadian Excise Tax Act already been, they updated
right.
and they include the virtual currency as a financial instrument for payment. So
Exactly.
It's already well covered in that.
Yeah.
Case.
And it's interesting because you'll continually starting to hear this term virtual currency. So although it's not a legal tender per se, they're using the term of virtual currency. So treating it as its currency, even though it's not legally tendered by the banks, et cetera. And, you brought up a good point that last year the Excise Tax Act was updated. And, everything we're kind of talking about today as we were preparing for this webinar, something new has been coming out every week, every 2 weeks, both by the IRS and the CRA with respect to administrative positions, laws they're changing, adapting in order to incorporate a lot of this. So it's important to remember that if you're trading, mining, anything in the world of cryptocurrency, using it as receipt of tender for products, you want to make sure that you're continually staying up to date because the authorities are changing very rapidly their laws, their regulations, their administrative positions on how this is to be treated. Because everybody's learning about what it is and it's evolving in how it's operating. So the authorities need to also evolve in the way that they're catching the information. Now, you can't actually invest in cryptocurrencies in any type of registered accounts. So your RRSP, RESP, et cetera. However, there is a way if you are wanting to invest in these cryptocurrencies, and that's by using funds. So there are certain funds out there that invest in cryptocurrencies. Now, I read an article the other day about some of the management fees of those funds that invest in cryptocurrencies. And so you always have to do an analysis, the cost benefit analysis. Is it worth it on the tax that you're saving versus the fees you're paying? But it is possible if you want to have some type of crypto investment within your registered accounts to invest in one of the funds that manage a crypto wallet, if you will. And similarly, cryptocurrency at this point, although you can pay people technically as cryptocurrency, you can't issue any type of, or it's not eligible, for any type of the stock option benefits. So the deferral of income under the stock option rules that you would normally see when you issue stock options in stock of a certain company, issuing cryptocurrency is not recognized for purposes of that deferral. And so what are some non-taxable transactions? We talked a lot about what can be taxed and what should be taxed and what should be reported, but what are you okay in doing? One is exchanging between wallets. Now, when you're looking at exchanging between wallets, that's just keeping the same crypto. You primarily just want to go from here to here to a different holder. That's not going to be considered a taxable event. So long as you're not changing the currency that you're invested in, you're not exchanging it for any legal tender, et cetera. You're just moving it from one investment to another or one wallet to another. You don't need to actually recognize any type of gain loss on that transaction. You also can look to maybe if you want to put your investments into a corporate structure or partner structure. Again, because this is property, it may qualify for a tax-free rollover into an organization. Now, you need to be careful. Is it worth doing that? You got to look at all the other different types of implications and ensure it actually qualifies based on the specific attributes of those investments. But the fact that it's property, you have the ability to potentially roll those over if you choose to into some type of structure that's a corporate or a partnership. And finally, looking at donating. So similarly to stocks, cryptocurrency, you can donate those to a registered charity recognized by CRA. And if you do that, you're not recognizing any of the gains that have attributed to that cryptocurrency. And you'll get a full donation deduction for those. Those are recognized as donatable to registered charities.
So we document the fair market value.
That's right.
To get the receipt in the substantiate.
Well, you'll need to, and it should be available in the wallet, the fair market value of the cryptocurrency, so you'll know what the value is. So, yeah. All right. Well, if you want to hop on over to the south side of the border, Cooper, and talk a little bit about how the IRS likes to view cryptocurrencies.
Sure. And, no surprise, IRS takes position similar to what CRA does, even though it's not foreign currency, but cryptocurrency is taxed as a property, because there is always some value attached to it. And but for some other information disclosure purposes, it could be reported as a foreign currency. So we're going to go through some taxable, non-taxable scenarios. So just some examples to go through.
Yeah, it's interesting because IRS and CRA both kind of take the same viewpoint on this of it's not really currency, but it is currency, depending on what we're trying to look at. Are we trying to look at tax or are we trying to look at reporting? So they go through both sides of the border, if you will. And we always say, there's a lot of similarities between Canada and the U.S. and their taxing system, but the devil's in the details that you need to watch out for sure.
Exactly. So if you look, the first slides here for the U.S. tax treatment and the cryptocurrency, if you sell, exchange your cryptocurrency you own for some other legal tender, like U.S. dollar, Canadian dollar, you recognize the gain or loss compared to your cost basis, Then if you exchange one type of a cryptocurrency, let's say a Bitcoin, for Ether, or Ether, should pronounce that. So then there could be a capital gain realization there. Or if you trade it for either goods or services by the cryptocurrency you own, then it could be a capital gain or loss. So when you do all of these transactions, you have to follow, usually the first in, first out cost basis, which is a little different to what Krista just explained by CRA. Usually they take the average cost basis method. But in CRA size, because, digital currency, it's easy to track because usually you buy them, put in the wallet, you have your private key, you have some special access code. So it's easy to track which coins or which fraction of that you use it for your exchange. Mm-hmm. So we often call the FIFO here is a first in, first out cost method.
That's an interesting thing. A lot of our clientele that we deal with are U.S. citizens living in Canada. And, part of what can happen with that is you potentially have a mismatching of income reporting on both sides of the border. So it's something you do need to watch for. The costing of your cryptocurrency if you're a U.S. citizen living in Canada, because as we said, Canada's average and U.S. is first in, first out. So there's a little bit of a reporting difference, if you will, for those individuals.
That's a good point. For, let's say, dual citizen or Canadian resident here, when they usually they need to file both sets of returns. Yeah. If you report all of these capital gains from transaction, in addition to this cost basis difference, there also will be some foreign exchange, gain or loss consideration there. So there could be some income amount or foreign tax credit amount mismatch.
Exactly.
Okay. Then if we go to the next slide, so just a few examples here. We talk about the capital gain recognition from the last transactions we have. Now it's more like ordinary income. Okay, we explained what mining is. So if you earned some cryptocurrency from the mining process, then generally it's ordinary income. What's the difference between ordinary income and the capital gain tax? Why, if you hold something more than 12 months, for the U.S. tax purpose, we often call the long-term capital gain. So it will be subject to lower tax rates. But for ordinary income, like a business income, salary, they're subject to the ordinary income tax rate, which is much higher than the long-term capital gain tax rate. Okay. Then for cryptocurrency, sometimes you can, put the fraction in the pool to earn some years from that. It's kind of an interest earning. So that interest earning will be taxed just like interest as ordinary income. It's not dividends. And so it would be subject to higher rate. So then if you look at the airdrops, in the digital currency world, there's so many new currencies or coins come out. So, sometimes at the beginning, they're trying to invite people to adopt their new coins. So they send you some free token for you to use. And so for airdrop, you would have to recognize income when you receive it. Unless you have wait for, let's say, 2 months or half year before you get full dominion control, then the income recognition could be deferred. Otherwise, it will be taxed the way you receive it. You will count it as a fair market value, included as your gross income for that year.
It's interesting because it's the U.S. on these things is actually quite similar to Canadian reporting. Would you say?
Yeah, it's pretty similar. I mean, they both want more money from tax. Not much difference.
And they want it as soon as possible.
Yeah.
Yeah, exactly.
Well, like you mentioned before, there are more regulations or revenue procedures come out in the future. So this is a new area for the tax point of view. So we need to watch closely. Yeah,
exactly. And, it's as I alluded to on the Canadian about the foreign reporting. I know you're going to talk about the U.S. reporting in a second, but the U.S. has even said, right? I mean, they ask you, what's your name? What's your address? Do you have virtual currency? It's right there.
On the tax return, there's a line of very specific questions. They ask you whether you buy or sell or exchange any
or receive or anything. Yeah.
Yeah, you mentioned good point for receive. We're going to talk about it later. If you give your cryptocurrency to other people as a gift towards a tax scenario like that, which is a little different to CRAs. In Canada, we don't have any gift tax regime, but in the U.S., we do.
Yeah.
So regarding the U.S. tax reporting, these are all like specific forms, popular forms to kind of for disclosure purposes. And, the 48300, if you look this for, you Google that, you will see this is required you to report any transactions more than $10,000 cash. But in this scenario, RS say, hey, even though it's virtual currency, but we treat it like cash. Otherwise, it's hard for them to track those transactions. And also for 8938, it's a schedule of form to your personal tax return. So if you, let's say, you hold your funds in the foreign account or in the foreign wallet, digital wallet, then it could be subject to 8938. Depends on the value, So
the 8300 is something that's generally done by, I guess normally it's done by the financial institution. So in a situation where it's held in a wallet, is the taxpayer supposed to do that if there's nobody else to do
Usually
it?
it's a recipient.
Yeah.
Financial institution, under the U.S. FinCEN, financial. They're trying to kind of identify the fraud transactions, especially after the 9/11 event. It could be related to terrorism, money movement. So they're trying to track all of those.
Yeah.
The FBAR form, I think it's nowadays getting very popular. Most of the audience know this. This is a popular RS form for you to disclose any financial accounts you had in foreign countries. If the total aggregate value is more than $10,000 U.S. at any point, at any point during the year. So, I mean, these forms, it's kind of a vague regarding for the disclosure requirement. The RS or FinCEN or the U.S. Treasury, they have not covered this on the FBAR reporting, but the specific measures they're going to come up with more guidance. They need to cover this, So just be careful.
And I think there was proposed regulations that came out, but I don't they haven't quite finalized them yet. So.
Yeah, I mean, these, like I said, it's changing rapidly. And also the penalty for all of these forms, like a minimum $10,000. And it could be added up if you have repeated failure or you respond to the RS notice lately, and the penalty can get added in. So watch out for this. It's kind of like a CRA form T1135. You just mentioned it. But in Canada, usually the penalty is much lower. The US side is more harsher.
Mm-hmm. Well, that's a good point with the penalties, because we're looking at potentially, let's say, $2,500 in Canada, whereas the US with FBAR, you could look at 50% of the value of your assets not reported. So it's definitely, it's not something that we really, us in the cross-border world, we don't take it too kindly on the foreign reporting. We would never recommend not reporting something. If it's potentially should be reported, we include it on there, because the risk of not disclosing it and the IRS wanting it is just too large. And it's information, right? It's not taxed, it's just information.
Yeah, but lots of work. Don't get me wrong.
Yeah.
We often have clients say, "Hey, my return is simple. Why are so many papers?" Well, like these forms, there are many pages there. You need to disclose your location of your accounts, the account number, the address, everything. It's well covered there.
Yeah.
And I'm going to talk a little about, if you go back to that slide.
Sure.
Nowadays, let's say you provide some services to some company or any entities. You get paid by cryptocurrency. Because, nowadays, some startups company, they lack of a cash flow. They said, "Hey, we do things interesting here. You want to share some fraction of my, or could be like a newly minted cryptocurrency." So in that regard, it's treated as a compensation. Okay? You need to recognize that income at the fair market value of the cryptocurrency you receive. Then for the payer, they have the same obligation, just like they pay you cash or bank transfer. So let's say the form like W-2, like 1042 or 1099, those like income or income information return, you're gonna need to issue those, then copy to the IRS to let the IRS know, hey, I paid this guy for the services. So in that way, the IRS will know next year if somebody don't report their income from the payment in the form of a cryptocurrency. So the same reporting or information reporting disclosure are requirement there. And I put our RA here, in the U.S., it's like a Canadian RSP. So there's some news saying, hey, some RA provider, they are very creative. They said, hey, you can use your RA to buy some equipment. Then you do some mining activities. You earn some cryptocurrency. The cryptocurrency will be under your IRA's account. So you get taxed deferred, It's kind of a new thing, it's a new idea. I don't think IRS will like that. Generally for registered account, they have lots of limitation there regarding what is it's forbidden transactions or activities. It's like mining is like more like a business than a hobby. Even for a hobby, maybe you cannot put in the RA. So I just warn some people, don't be too creative, because if you got caught, could be some penalty interest there.
Exactly. And I talked about that on the Canadian side. It's similar. You can't put it in directly into your RRSP, right? So.
Yeah. So if we go to the next slides, this is some non-taxable transactions. This is what people love to see, okay? So first of all, if you just use your money to buy some coins, that is non-taxable, just like you buy any other products. If you transfer the same cryptocurrency from one of your digital wallets to another one, that is tax-free. But be careful, it should be, the same coins. You cannot exchange, transfer the Bitcoin, I'm gonna get some other coins in a different wallet. That is exchange. At that point, the game of loss can be recognized. Then, for the tax-free contribution, similar like you mentioned before in Canada, if you contribute your cryptocurrency to exchange your partnership interest or your corporate share, then usually it's taxed before. It's free rollover. You carry on your cost basis. Then for gifting, I mentioned in the U.S., there is a gift tax regime. If you give your cryptocurrency to your family members, to your friends, generally it's non-taxable transaction. Unless, there is some unified credit shared with estate tax, that would be large, like $12 million nowadays, with consideration of your accumulated gifts, you used it before. In that case, could be taxed at a 40% tax rate. Otherwise, there's no tax on gift for small gift.
That's interesting, because that's something that's actually quite different than Canada. Because in Canada, if you gift the property to somebody, it's possible that you're actually going to have to recognize the deemed gain on that transaction. So you need to be careful on the gifting of assets in Canada, because they're not always tax-free.
Yeah, that's a good point. Canada, there might be some attribution for income.
For spouses, exactly. Yeah.
So for the gift recipient, usually they carry on the cost basis from the gift giver, So in the future, when you dispose it, there could be a gain of loss. So you just need to track what's the value you got when you receive the gift. Same thing like a donation, no surprise. You can get some credit there. Just need some documentation there. Mm-hmm. I think that's just some examples for non-taxable transactions from the U.S. tax perspectives.
Yeah, I mean, it's all, as we've kind of been saying throughout the webinar, there's a lot of things that are coming into play very frequently by the authorities as into how to report different transactions and income, foreign reporting forms, changing of the laws. And so it's always just, I mean, as with anything in tax, it's as good as it is today, but tomorrow it could be something different. So you really need to be careful because this is something that's, even though it's been around for quite a number of years, it's only now becoming popular. So the governments are going, okay, we better catch up here because more people are doing this. And we need to be careful we're not missing out on tax dollars somewhere, somehow.
Yeah, exactly. I talked to one of my friends in Alberta who, is doing the mining activity on the corporate structure. So you will see more and more like mining activities in some area, like where the utility cost is low. But nowadays in the gas fees, it's not that cheap. No. And in the U.S., like Texas, Arizona, Wyoming, those are hot spots for mining activities. And in states, there are many states, it's about 35 states, they have different bills to, brought up to address what kind of a tax incentive measure they can provide to invite the mining companies to settle down in their states to just boost the employment or revenue, Some of those have been enacted as law. So there are lots of interesting things to watch nowadays. So basically today we're just talking about from the U.S. federal level, but in the states, most of those are just like they follow the federal tax law. But there could be some variance there. You need to verify it for the state tax purposes.
Exactly. Yeah. Perfect. Well, that about wraps up the discussion. I do know that we have some questions that have been asked throughout the webinar. First off, thanks for those who hopped on and joined us today for this discussion on cryptocurrencies in Canada and the U.S. Remember, if you could please complete the survey for us so that we're able to receive some feedback, subject matters people are interested in hearing about in the future, any other items. And if we do not happen to get to all your questions today that have been asked or we don't have answers, we will definitely follow up with you after the webinar. Someone from our team will connect with you to reach out on the questions if we're not able to get to them all or answer them. And today on the line, we have Shan, who's a senior manager in our Vancouver office, who's going to be moderating the questions that have been posed throughout the webinar. Shan, do we have any questions?
Hi, yes, we've got some very interesting questions, actually. So the first one is regarding, for example, a client is creating its own cryptocurrency and sells it on a public platform. What type of income would this be? And is there any qualifications as inventory?
Well, I mean, we talked about Canada or the U.S.?
Oh, we didn't specify in this question, actually. You can
okay.
Yeah.
Well, I think the answer might be the same similarly for both. If you're creating something and you're in the business of doing that, it's likely that that's going to be treated as business income. Again, we need to look at the definition. Are you doing it as a hobby or is this what you're actually doing for your business and creating it? And we alluded to it a little bit earlier that cryptocurrency doesn't technically create inventory, the same that you would kind of view it in other types of mining environments. What it does is the minute you receive that cryptocurrency and people buy in, if you will, that's a revenue recognition if you're in the business of doing it. So there's no kind of deferral as inventory for future sale because you're receiving it. And then when you sell the cryptocurrency, you're going to have that gain loss.
Okay, thanks for that. The other question is on can you comment on the tax treatment of donations of crypto to registered Canadian charities?
So yeah, we talked about that a bit. Yes, it is possible to donate your crypto into registered Canadian charities. It's a property similar to other properties, so you can make that donation for the fair market value. Is that the question? I think I answered the question.
Thanks, Krista. So how should one treat income from staking and the liquidity pools?
Staking is like you have a fraction of your coins, but you don't want to trade it, but you want to lend it to someone else, kind of lock down your coins for a while. So other people or the borrower, usually the financial institution, they can pull all together. They can kind of create some hedge tools for financial instruments. So they can do activities based on the coins you have. So it's just like then you earn some interest income from it. It's a fixed income, it's safe. So that suits some people's needs for their cryptocurrency ownership. So in that regard, usually it will be taxed as ordinary income. It's not capital gain because you have not sold those. You just, you give to other people to use, they pay you. Just like royalty income or interest income. So it will be taxable as ordinary income. Well, would
it be like other investment income kind of treatment?
Yeah.
Yeah. Sorry, so it's marginal rates, but it's kind of like other investment income. It's not interest per se,
like a GIC type, you cannot touch it within the next 1 year, 2 years that you get something. In the digital world, there are so many fancy names. To be honest, we're not expert in the cryptocurrency regarding those technology terms. From my superficial understanding, that is how the stake is about. So generally, you earn some ordinary income from it.
So thanks for that explanation, Cooper. So it looks also like we have some confusions between mining versus buying or selling Bitcoins. For example, is mining kind of required when you buy and sell cryptocurrencies? Can you expand on that?
Yeah, we touch base a little bit on mining process. It's basically like the services you provided by using lots of equipment, the servers to solve the mathematic puzzles, trying to get some hash value, trying to match. First of all, you validate the blocks assigned to you to see whether these transactions are true, then if those blocks get validated and you send it to the network, the larger blockchain, if the block got accepted by the blockchain, then you get awarded because you have done those work, by the calculation based on your equipment you have, the faster, you might have a larger chance to get recognized or get accepted. Then if you got accepted, you can share some award in the mean of two ways. Usually either the newly minted Bitcoins, okay? By the way, Bitcoins is capped as $21 million. And because most of those have been found. So nowadays, only less and less will be minted out in next years. So people rush to get this industry because it will get harder and harder to get a newly minted cryptocurrency or the Bitcoin in this scenario. So if you get that reward for the new minted Bitcoins, or you share some, you get award by the transaction fee, usually they call, by a share fraction of the existing cryptocurrency. Those, it's just like you exchange your services, get some properties. You can, the property can be valued at that day because all of these main coins are actively traded. So you have value there when you get the rewards. So that's why both CRA and RS, they want to tax that income at the day. I mean, you need to recognize the income. So when you file the return for that year, you have to report those income. You cannot default like the traditional mining for those gold, silver inventories.
So if I were to just kind of summarize, mining is basically the service of using someone's computer and they're paid in cryptocurrency. Trading in cryptocurrency is buying and selling cryptocurrency.
Yeah, you get what you
very,
have
very
from the mining.
Yeah,
you recognize your income as
that's
ordinary
right.
income. Then you have a cost basis for your future sale. So unless you sell or exchange the cryptocurrency you got from the mining, from this period, there's no tax free event. But in the later, you can recognize either capital gain or capital loss by comparing the date of the sale, the value, to the original cost base, or I would say the income you recognize at earlier date. So it's like two phases for income tax treatment.
Exactly. Do we have another question there?
Yes, I we just received a follow-up question on that, stating question whether it's reported on tax return as other investment income in Canada.
Right. Yeah. So Canada and the U.S. would treat it the same.
Okay.
It's not really interest, but you report it as other investment income, similar, like Cooper said, like a GIC type of idea, because you're lending it out.
Yeah, one of the things to watch for is in Canada, because there's the information reporting by the payer is not that strict like in the U.S. So in Canada, maybe even though you don't get a tax slips or information to summarize what you get from the staking or a liquidity pool, maybe you should report it based on your own calculation. You need to verify that. In the U.S., going forward, you probably will get some like information slips.
1099 or something.
Right.
Mm-hmm.
It will be much easier. Yeah.
Awesome. Well, I think we have time for one more here, Shan.
Okay. So if you sell cryptocurrencies and generating business income, is GST or HST applicable?
We'll probably have to get back on that one. I'm not sure on the specific Excise Tax Act provision with respect to that. Cooper, do you know?
Not really. I'm not an expert, to be honest.
Yeah,
So
we focus primarily on income tax, but we certainly could get back to the person on excise tax if they're in the business of buying and selling cryptocurrencies.
Do we have time for more questions?
Probably can ask one more just because that one was quick and we couldn't answer it.
Okay. So are taxes recordable and payable on purchase and sale of each cryptocurrency, or just on transfer of funds in and out of the platform? Also, is there any level of de minimis rule there?
There is no de minimis rule. The minute you make $1, you pay tax on $1. As far as when is the tax owing, when you buy, there is no tax because you're purchasing it for cash generally, as long as that's what you're doing and it's not some other barter transaction that took place. But when you sell the cryptocurrency back for some type of legal tender or in a barter transaction, that's when you're going to recognize the gain or loss.
Thank you. Yeah.
Awesome. Well, thank you everybody for your participation and for the questions that we didn't get to and need to follow up on with respect to the Excise Tax Act, et cetera. We'll connect with you separately or someone from our team will. And Cooper, thank you very much. It was a pleasure presenting with you today. And Shan, thank you for the questions.
Thank you.
Bye-bye, everyone. Thanks.
Bye.